Chief Life Insurance Magician, Darren Hardison. Hello, Darren.
Good morning. Good morning.
Good morning, and thank you for joining us.
My pleasure.
Today's focus is whole life insurance. Is it really a good deal? And of course, it's a topic because whole life insurance has been around a long time. So why don't you give us a little bit of an overview, Darren? What exactly is whole life insurance, and how does it compare to the other life insurance products?
Yeah, it's funny you mentioned a long time. I wrote an article years ago about the history of insurance. So insurance and annuities, for that matter, have actually been around since ancient Greek and Roman times. As far as the concept of insurance, pooling monies to help people offset funerals, or an annuity for that matter is in essence a promise to pay a certain sum of money. But it's fascinating. Another fun fact: so life insurance, at least in modern terms, how we think of life insurance, actually came to fruition. I think Benjamin Franklin actually was credited with it in the 1700s, introducing the concept of whole life insurance. And then, interestingly, I read this. Another gentleman at a similar period of time in the 1700s introduced term life insurance because he was declined by a whole life insurance company. So it's fascinating. But fast forward, let's say, into our past 50 years, whole life insurance was basically it. If you were buying permanent life insurance, it was whole life insurance. That's what it was. So the concept of whole life insurance, it's all about guarantees. I'm paying a guaranteed premium. It can't change. I'm buying a guaranteed death benefit that can't change. Well, it can change. It grows with the cash value. It credits a guaranteed interest rate. The insurance company promises to credit interest at a certain rate every single year. And then the majority of whole life companies are mutual companies, which means they also pay a dividend. Not guaranteed, but it's as close as you can come to a guaranteed when you have a financially superior, big, rich, double A+ insurance company, and they all like to brag and compete with each other as far as who has the most historical trends of meeting or surpassing their declared dividend rates.
So whole life started out with the concept of insurance for your whole life, which
Yeah.
if you are buying insurance to take care of final expenses and make final arrangements makes kind of sense because you want it to last as long as you do. Okay. Um, and as you're mentioning, it's very guarantee oriented. Is it still as popular as it once was?
It definitely still has a place. Let me maybe differentiate between whole life and maybe other types of insurance. So the concept of it of whole life, as an advisor, if I was sitting in front of a client and I was trying to explain it or sell them on maybe why they should consider it, it's first and foremost, it's life insurance. You're protecting your family. You're protecting some insurable interest. Okay. There's death benefit. So a portion of the premium I pay is to cover that cost of insurance. The cost of insurance is based on my age. It's based on my medical history, as you know, which is why we pre-qualify everybody when we do underwriting. And the balance of the premium goes towards the investment account. I call it like a bank account, a savings account. So that excess premium is invested at the company, and it's credited the guaranteed rate or the dividend rate. Okay, so over time, I've had this protection. I've had $1 million policy. I've paid my premium every single year. Fast forward, I'm 65 years old now, and I've amassed this sum of cash. This cash is accumulated. Life insurance, as you know, is a tax favorable vehicle, meaning that the cash accumulates on a tax deferred basis. The IRS still is friendly towards life insurance if you structure it properly. And then, oh, by the way, when and if you decide to take distributions, if you design it properly, you can actually take loans from your policy that you don't pay back on a tax-free basis. I always make the analogy of, look, it's life insurance, it's not a pure investment, but if I was comparing it to an investment, it's kind of like a Roth IRA, meaning it accumulates tax deferred and I can take money out tax-free.
Got that, with a qualifier being that if a claim is paid with an outstanding loan, it's the death benefit minus the outstanding loan plus interest. So I'm sure that
Yeah, correct. There's always going to be a net death benefit. Typically,
okay.
the death benefit is never less than the original stated death benefit. We could get into paid up additional insurance. That's maybe too deep for this conversation. But yeah, it's life insurance with a cash feature for somebody who's very permanent minded.
Okay. All right. So people that are advocates of universal life insurance are also permanent minded. So
Yeah.
why would somebody choose whole life as opposed to universal life?
Yeah, good question. So again, I'm the same advisor. If I'm sitting in front of clients and maybe I was trying to differentiate the two or sway somebody towards universal life, I would say, well, whole life is expensive relatively. You're going to pay more in premium to get the same potential cash accumulation that you may be able to achieve with universal life. Universal life was designed much later. I think, when did we start seeing the first universal lives? In the 70s,
80s,
80s,
late 70s, early 80s.
80s. So it's a variation of whole life where they built in more flexibility. They built in more assumptions versus guarantees. Again, it's, universal life oftentimes are offered by the same companies. So there's still that same degree of safety. It's just they're not as guaranteed. So what you give up in guarantees, you'll get back in flexibilities. But they both can get you to the same place, if that makes sense.
No, I get it, but you're saying on an apples for apples basis, given the same face amount and so on, the reason why the premium for whole life would be higher than universal life would be because it's supporting stronger guarantees.
Correct. Yeah. Yeah.
So at the end of the day, it comes up to the so-called risk tolerance of the policyholder. If they're very guarantee oriented, then they would probably want to choose whole life. And if they're less guarantee oriented, then you're saying universal life would be an option.
Yeah. And we've had clients, this, that have approached us specifically wanting whole life insurance. And they understand it's insurance, that it has a death benefit, and they say, well, that's interesting. I want it for the safety and to have a non-market correlated asset inside of my portfolio. So it's insurance, and they know this. They understand they're paying a cost for this, and heaven forbid if something premature happens and the death benefit is paid. From a pure math perspective, this sounds terrible. The rate of return on that investment is, astronomical. Assuming they don't die prematurely, then that cash value, albeit modest, is not going to compete with the market. It's not going to compete with different indexes and other investments. But to have that, the base of your pyramid, if you will, that ultimate safety inside, that's growing tax deferred. Most investments are not growing tax deferred. It's just, it's a piece of the puzzle.
Right. It is for those people that follow the philosophy of you need a diversification in your assets, a risk diversification, which means you'll have higher risk at this end and lower risk at that end. You're saying for those people, there are people choosing life insurance, whole life insurance for the lower risk end of their portfolio because of the safety, because of the guarantees, and frankly, these days, I'm sure against alternatives like T-bills and money market funds, it's a no-brainer as to what the guarantees of whole life insurance are offering. Okay. And then plus it's life insurance, and should the policyholder die, there's a big bucket load of cash that goes into the portfolio. Okay.
Yeah.
So having said all this, give us an idea of the types of consumers who would lean towards this, besides the fact that they might use this product as the conservative part of their portfolio. What about ages, situations in life? Who are good candidates for this product?
Where we see it a lot is we see a lot of parents and grandparents establishing insurability on their kids and grandkids. Again, it's my grandparents used to buy me Series E savings bonds. So it's a similar thing where you're gifting a sum of money, but you're establishing insurance that the individual will be able to take with them into the future. It's accumulating cash. I actually bought my son a whole life policy with Mass Mutual when he was born. Again, I'm an insurance advisor. I believe in insurance, but it wasn't, for the insurance per se. It was just another piece of the puzzle. So when he's 25, 30 years old, he's going to have a chunk of money sitting in there. Hopefully he uses it responsibly. But it's just another piece. As far as adults buying it on themselves, yeah, it's a mindset. People still like guarantees. Now, if someone's more conservative minded, risk averse, those people tend to gravitate more towards whole life insurance. The higher risk individuals, maybe the index universal life, where they like to feel like they're playing in the market. They want to do what the market's doing. Again, it's personal preference.
Yes, and I'm gonna add to that. It's not just based on risk preference, and it's not just based on age and the amount of time you have to let the cash accumulate, but I'm also going to throw into the equation insurability, because I'm sure you have found that people who have a higher insurability risk, such as a medical condition or any other reason why the cost of insurance would be a little bit higher, they're not good candidates for whole life insurance. Have you found that to be true?
Yeah, and whole life insurance companies, again, I'm talking about the big mutual companies, the Mass Mutuals, the Penn Mutuals, Guardians, New York Life, and then the Northwestern Mutual folks who are kind of off on their own island. Very, very conservative, very not outside of the box in underwriting and pricing. So not, again, they're old line companies, so not real forward thinking in underwriting oftentimes.
Right. And I think that's by design. It's because the higher the cost of insurance, the higher the cost of insuring a policyholder, the less money there is to use as a surplus inside the policy. So
Yeah.
if I'm a whole life carrier, if I'm a mutual insurance company, and I want to brag about the great cash accumulation that's taking place inside my policies, I only am going to want to insure people where the cost of insuring them is going to be as low as possible.
Yeah, and I always remind people, insurance companies are for profit. They're actually trying to make money. So, for instance, when they meet with their board of directors and they're going to declare their dividends, they're actually looking at how did their investments do? What's their internal, rate of return? What interest did they credit from their own investments? They're looking at their claim experience. How did we do in underwriting? Did we do better? Did we do worse? Meaning, how many checks did we have to write this past year? And then, operating expenses, how efficient is our company? So they take those factors, and ultimately that's what they use to decide if they're going to sustain their declared dividend, if they're going to reduce it, or if they're going to increase it. And they all put out these fabulous charts about, well, for instance, so 2022, last year, historically bad year in the market. S&P down 19%, right? Bond market down 14%. Terrible year, no place to hide, right? Virtually every whole life insurance company either maintained or increased their dividend payout. It's amazing. That just shows you how they invest differently and how deep of pockets they have.
They're deep pockets, and they're typically remarkably well run, which is why these life insurance companies have withstood all kinds of market changes, large scale economic changes, and people are still making money, and they're still paying out benefits. They're still putting a bunch of cash inside people's policies.
Yeah. I joke with clients, and they'll be asking me a question about their policy, and they're worried about the insurance company. I'm like, please don't worry about the insurance company. They're going to be fine.
They are, and historically that's proven to be true.
Yeah.
All right, Darren. So we've discussed how the product works. We discussed its strengths. We've discussed who it's for, and we've discussed who it's not for. Is there anything else you'd like to add?
It's something we probably don't talk about it as much as we used to. We'll usually use the term permanent insurance now. So a client either is looking to protect a period of time, term life insurance, or they're concerned about locking in their insurability for their entire lifetime, or to age 100. So really it's something I like to do from an educational purpose is be sure they understand the difference. A lot of times they'll say, well, can you show me whole life and term? And I say, well, when you say whole life, a lot of people mean permanent. Here's how whole life works. Here's how universal life works. Again, like we said earlier, you can kind of get to the same place, but here's why they're different. So a lot of times it's, a lot of what we do is education, being sure our clients fully understand what the heck is out there. And then once we collectively decide what is suitable for them, then we go out and be sure we're getting the most efficient, package for them from, whatever insurance company.
There you go. It's all client centered, and may the best product win per that particular client. All right, Darren, once again, you've spun our heads with your magic about life insurance. I appreciate you putting it all there on the table.
My pleasure.
Thank you so much, and thanks everybody for joining us. We will see you next month.
All right, guys.